the number one struggle most people deal with in the world today is money. What is happening in the stock market? We are glued to the television. What is happening with inflation? Are we in a recession? My special guest tonight, Chris Graper, is going to fill us in on all of that and so much more. We're excited to have you on the set.
Thank you for having me. I'm very excited to be here.
Oh, this is
a lot of fun.
This is a lot of fun, and you're going to make it fun because when we deal with finances, it puts people over the edge. I know a lot of people don't even turn on the television anymore because it's truly a roller coaster.
Oh yeah.
So what is happening in the world today, and how did we get there with this stock market? We don't even know. Maybe crash, up and down. What's happening?
There's been a lot going on this year. A lot of volatility in the market. We've obviously turned on your television or open the newspapers. You're seeing headlines left and right about Fed raising rates or inflation or all sorts of economic conditions going on in the U.S. or the global economy, and so. Right now we're in a digestive time in the stock market where we've had about 10 years of stimulus and lower rates to where you had this ample liquidity, and so a lot of people went on spending sprees, and so when that happens, a lot of demand gets pushed through the economy, and lack of supply causes inflation rates to go up, and so right now the Fed's trying to calm those inflation rates down by taking proactive measures by raising the Fed funds rates. And so what that does is it hopefully tries to slow down the economy. Even though it may sound bad, they have to curb inflation somehow. And so most recently, the inflation rate this past month was 8.5, 8.6% year over year, which sounds ridiculous because historically it's usually around 2 to 3%.
Right.
And so in order to try to slow that down, the Fed's raising rates to try to stop excess spending, stop borrowing, and hopefully calm down the costs you're seeing at the gas pump, rents, supermarket, and everywhere else.
How sad, though, that really has to happen.
Oh, yeah.
It sounds like, oh my gosh, that's the worst in the world. But it actually has to happen, or we indeed will be in a recession.
Right. And they have to do it very delicately to make sure that they don't cause an earnings recession. And you're hearing the recession term thrown around a bunch right now, and actually, technically, you probably heard President Biden talk about recession.
Right.
Because technically, the definition of recession is 2 quarters of negative GDP, which we've had as of the first half of this year.
Right.
Where normally recessions are caused by earnings recessions, meaning earnings are taking a hit, where that's not happening right now.
Right.
So this recession was caused by essentially the dollar being too expensive and doing too well, to where now it's more expensive for foreign buyers to buy our exports, and so people aren't buying our exports anymore, and we're getting this surplus inventory glut, to where now that's what's caused the negative GDP is the surplus exports, because people around the world aren't buying our exports anymore, and so.
Right. That's a big hit.
It's a big hit.
It's a huge hit, and everybody is impacted by that. Everybody.
Oh, yeah.
You talked about the inflation rate. You said it's at
8.5, 8.6 right now, year over year.
8.56.
And so there's a core inflation, and there's the normal inflation, which you're hearing every day, which includes gas and food, but core inflation includes everything else.
Right, because we briefly talked on the phone, just a meet and greet, and you were talking about people that live on a fixed income, because there's a lot of people out there that have a Social Security check. They don't have investments. They don't have a lot of money that they can rely on, and their check doesn't go up as much as the inflation rate goes up. How do they deal with that?
Right. So kind of the basics of financial planning, you might have heard this before, is that you have a 50% of your check that you get, whether it's Social Security or something that if you're still working and you're earning, 50% goes to things that you need. Then you have 30% that goes to things that you want, and then 20% is supposed to go to savings. That's kind of the golden rule of how to cash flow plan with financial planning.
If they have a good financial advisor.
Yeah,
if they
we
don't.
get a little bit more in depth with that of cash flow analysis, but that's kind of the basics. And so with this inflation rate so sky high, people are spending more on the things that they need have less money for the things that they want, and even less money for the things that they want to, or the money that they want to save every year
Right.
towards retirement.
So then you just have to save less. That's the only answer.
You save less, or
'Cause you don't have it.
you save less, or you make cuts. You buy
Smaller
non-brand
house.
name
Right.
items that you want. You smaller house. You may not go out and buy the purse that you want or the watch that you want anymore. Whereas in the years past, because we had the stimulus and all these low rates that you could borrow at low costs, you could buy whatever you wanted. And so now we're kind of paying the price for that.
So basically what you're saying is live within your means, whatever that means is now,
Right.
and deal with your wants, not your wants, your needs.
Prioritize your cash
Prioritize
flow.
your
Correct.
cash flow. Exactly.
Right, and then also there's you kind of want to have a safety net built into your finances, right? So another rule of thumb with financial planning is that if you're in a dual income household, we recommend having at least 3 months of living expenses covered just as a safety net nest egg in your checking or savings account because you have dual incomes, and so if for some reason the husband or the wife or whoever loses their job, you'd still have the other income of the other spouse, and you'd have another 3-month cushion to help supply living expense needs
Right.
while the other person's trying to find their job. If you're in a single income household, the rule of thumb is 6 months, so just double it.
Right.
And so but if you're in retirement or if you're living on fixed income when you're older, you want to make sure that you have that nest egg built out further so that when you run out of the 3 months or 6 months because you're just living on your cash flow,
Right.
that you stagger your investments. So you have, in your retirement accounts, you have those invested the most aggressive because those are the last assets you're going to touch. In your
Right.
IRAs, your 401ks, things like that. In your cash and your savings, obviously it's in cash, but you can also invest in short-term fixed income or money markets or corporate bonds, things of that nature. And those are less volatile than stocks. And so you kind of build a runway of your cash flow need by, if you need money now, you're pulling it from your checking or savings, but when that gets low, you sell off some of the corporate bonds of the money market or short-term instruments that are less volatile. And when that gets low, you start to trim off some of the more volatile positions that are riskier, like the equities that you hear from. And you just have this kind of waterfall effect. And so if your roof caves in and you got to go buy a new roof for your house, you don't have to sell off a bunch of stock. You have kind of a nest egg to dig into.
Right.
So you don't have to worry about these daily and monthly fluctuations in the market.
I love that.
That
I mean,
de-stresses you.
Right. And having a financial advisor to guide you through this, because sometimes it can be overwhelming.
Oh, yeah.
Overwhelming. And that's where
It's a
you
big
come
puzzle.
in. It's a big puzzle.
That
Yes.
dorks like me like to do.
I love it. You're not a dork. There's a lot of people that know that the financial world is going to go up and down. And we all know that every 10 years, every 12 years, whatever it is. But for those people that are closer to the retirement age,
Yep.
and they are depending on all of these different funds to supplement their income, or not live on it, but supplement it. It is, most people have 10, 12, 15 years to bounce
Right,
back.
right.
For those people that are closer to retirement and are depending on that money, how do you advise?
Well, as you get closer and closer to retirement, you should be more and more conservative. It really all depends on the situation and the person's, their time horizon, their risk tolerance, their liquidity needs. There's all these different factors that take place in trying to assess someone's financial needs and how they should be appropriately allocated. And so, it really depends on the situation. I'd tell them to seek out someone for advice, a professional like myself or someone else in their area that they know of, and do a financial plan for them or a retirement plan.
Right, because nothing's impossible.
Yeah, there's not a
Like
one.
even if you're closer to it, and the stock market's just
Oh, yeah.
crazy, and your 401k is bouncing, you can.
I would say
yeah.
touch base with a financial advisor like myself or a retirement professional,
Right.
because there's not a one
Fix all.
thing fix all or a perfect portfolio to put together to be able to save enough for retirement or go throughout retirement successfully.
Right.
So
So get some financial advice.
Get some financial
That's what I
advice.
say. So that leads into our next question. There are so many different vehicles of investment out there. We talked about mutual funds, the exchange traded funds, the ETFs, and then the SMAs. Can you break that down for us?
yes, so financial advisors like myself or other retail investors out there have access to a lot of different products. And so
This is diversified, though, right?
outside of
It's
just your
diversified.
stocks and bonds that you hear about on a daily basis
Right.
or more popular to speak about, you have mutual funds and exchange traded funds. And those are very similar as that they're pooled investments where they, one fund will buy a bunch of different stocks.
Right.
And so the main difference between the two is that an ETF trades throughout the day just like a stock, whereas a mutual fund trades at the end of the day at a set price.
Okay.
Another big differentiator is that mutual funds have a certain amount of cash they have to hold in the fund for redemptions. And so typically in bull markets, that will cause a little bit of a performance lag versus an ETF. Another difference is that ETFs typically are more passively invested, where they're kind of mirror a benchmark that you want to follow, whereas mutual funds are a little bit more actively traded, and because of that, they're a little bit more expensive. They have a little bit more higher internal costs and fees from that mutual fund company.
Okay.
And then separately managed accounts are ways that if financial advisors like myself don't want to actually do the stock picking and mutual fund picking and bond picking, then they have access to professional portfolio managers that they outsource or hire to manage the investment account.
Okay. So
So,
I love that you kind of broke all this down. Like, lots of times we have guests and it is like Roman. You broke it down, easy to understand, in all these different avenues of how, an investment should be, helping us understand our money and what's happening, and also understanding what's happening in the country with, the stock market and inflation, right? So you are amazing. We hope you come back.
well, thank you for having me.
Oh
I
my
really
gosh.
enjoyed this.
You were amazing. Thank you so much. Chris Graper, one of the leading financial advisors, giving you the skinny on how to maintain your wealth, how to keep your wealth, how to grow your wealth, and how to not be stressed out in this crazy economic environment.